Good afternoon, everybody. Good afternoon. Great to be here. Great to see so many of you here today. Fantastic to have you here. My name's Paul, for those who don't know me. Welcome to the Next in Admirals Trading Spotlight webinar series, where today we're going to talk about the power of the 20 period moving average and how to use it to trade reversals. So plenty to talk about there, always an interesting subject, lots for you to take away, all right, to be able to utilize in your own trading, which is the whole idea of the Trading Spotlight webinar series. First and foremost, if you're here joining us today, great to see you here. I appreciate we have a global audience that come and join us wherever you are in the world. I hope that you're safe and well, and thank you for joining us. I also appreciate that we have a very broad range of experience in the room, okay, from people who are complete beginners to people who've been trading for a good while, okay, and it's hopefully there'll be something here for everybody. We'll do a little bit of a basic introduction, but also what we'll do is we'll be talking about just a very simple tactic that traders from all levels of experience can take away and utilize in their own trading. So it looks like we've got a huge sum of people here, a great sum of people here today, and happy Easter to you, those who are joining it, who are celebrating it. Everybody else, it's fantastic to have you here. You are, of course, very welcome. If you're watching this later on the Admirals YouTube channel, then be sure to subscribe to the Admirals YouTube channel. Give us a thumbs up if you found this useful, or even a thumbs down. We don't mind. Okay, it's all feedback. We don't mind. If you've got thoughts or comments, okay, about the session, please put them in there. If you've got ideas or things you'd like to see us cover in the future, then by all means, please put them in there. We'll be happy to do that. And finally, before we crack on, just remember at the end of this session, you'll receive a small feedback form. Absolutely really fabulous of you. If you could just take a moment or two just to basically give some feedback on today's session, what was useful for you, what you'd like to see more of, maybe even ideas you'd like to see us cover in the afternoon in future sessions, because actually that helps us. Okay, we want to make Trading Spotlight webinar series as useful as we possibly can to as many of you as are so gracefully join us here on this what is a bank holiday here for many people in Europe at least. So without further ado, let's crack on, will we? So if you just bear with us a moment, what we'll do is we'll switch across. I'll bring the slides up and then we'll get cracking on talking about the power of the 20 period moving average. So there we go. We've got some. Let's bring that up there. Super. Excellent. So I said, hope you can see me, hope you can hear me, hope you can see the slide there. Great to have you there. There's so many: Andreas, Dalius, Peter, Raquel, Jeff Byrne, okay, Eric, Bando, Tina, Janice. We've got a very chatty crowd here today. It's fantastic to have you here. You're all very, very welcome. Hope you're enjoying your day and hope you've had a great and fabulous week. So let's talk about the power of the 20 period moving average. That's what we're going to focus on today. Just a little question, a little bit of housekeeping for yourself. It would be good to know, of those of you here joining me today, how many of you are happy and comfortable with moving averages? How many of you are comfortable with understanding maybe how to trade using the 20 period moving average? How many of you are experienced in trading something like a reversal? Be good to know. There's no judgment here. Okay, you can say whether it's been good, whether it's been challenging, whether you need to learn. That's absolutely fine. That is after all, one of the main focus of these sessions is to help educate you about different ways and concepts and themes and strategies and tactics that you can utilize in your own trading. Remember, here we are at Admirals, Forex and CFD broker with global presence and local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing the opportunity to engage in markets using both the MT4 and MT5 platform. If you have any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. We also have Admirals Trade Days is still up and running at the moment. Terms and conditions do apply, but there is an opportunity for you to receive up to €3,000 rebate, okay, to yourself on Admirals Trade Days. Once again, please check on the Admirals website or get in touch with your account representative, and they'll be very happy to help guide you. So today's agenda, when we're talking about, what is the power of the 20 MA? Well, what we'll talk about is, firstly, well, what is the 20 period moving average? What are moving averages? As I said, I appreciate we always have a broad spectrum of people joining us for our sessions, which might be complete and utter beginners. But we'll talk about moving averages, we'll talk about the 20 MA, we'll talk about why is it useful, and most importantly, for I suspect the majority of you, how do we trade with it? Okay, how do we trade with it in itself? So Andrea says, I didn't use moving averages until now. Raquel says, I mainly use the 20 and the 50 EMA. Jeff Burns says, I mainly use the 10 exponential and the 20 simple. So there's people here in the room who have got their own experiences, their own knowledges of how to use moving averages. That's absolutely fantastic. That's excellent. And I said, we're going to focus mainly on, what's the power in the 20 MA? How do I particularly like to use it in my own trading? For those of you who don't know me, my name's Paul. I've traded for many, many years. Okay, I've traded for hedge funds, for high net worth clients. Primarily, I like to focus on trading FX indices and commodities. That would be they're my preferred assets. And really, for me, what I really prefer to do is to sort of trade trends on the sort of longer term positions, and then sort of reversals and mean reversion on intraday. But what I'm going to share with you today is just a very simple tactic that works across all time frames. All right, and I'll show you a couple of examples at the end. If we should have the time, we'll be able to go across to the live markets and just have a little look at one or two of the tactics that have been setting up and running for the last few days and stuff. And I appreciate it. Always helps to be able to sort of learn a topic, but then actually see how it's playing out in the live market. So be sure to stay till the end to basically see that as we go across to the live markets. So the power of the 20 period moving average. As the slide says, many traders like to trade reversals. Often they will utilize complex strategies in order to call and then trade a possible reversal. Whereas personally, and it's my personal view, my personal trading belief, I believe that you should keep tactics as simple as possible. Calling reversals is not always easy. Your success is derived by generating asymmetric reward to risk ratio, which you'll hear sometimes we call R3, from your profitable trades. Today, we'll explain how you can identify and trade reversals using a simple 20 period moving average. So, as I've said, many people like to trade reversals, and many people like to trade trends, and you can utilize both the 20 period moving average for both trading trends and also for trading reversals. But today, we're going to focus mostly on how to use it for trading reversals. And those of you who've joined me on my previous sessions will already know that, I'm a great believer that less is more. You should keep your tactics as simple as possible. It is better to have a simple plan that you can execute flawlessly rather than a very complex plan which unravels in a very fast, dynamic, volatile market. So today, we're going to talk to you and show you how to identify and trade simple reversal just using a simple 20 period moving average. But first, what we'll do is we'll start with just a little introduction to moving averages. As I said, I appreciate there are people here joining us today who are completely new to trading, okay? And it doesn't really matter whether you've been trading for 2 weeks or 2 decades, okay? You're always very welcome here at the Trading Spotlight webinars. We're always trying our best to sort of try and cover as many bases as possible so that there is, interesting information that a new trader can begin with, but also something that an experienced trader might be able to take away and just sort of test and just sort of maybe look at sort of embedding into their own sort of style and way of trading itself. So, moving averages, all right, okay? Moving averages, let's have a very simple introduction to it. Moving averages are a very popular trading tool. Why are they a very popular trading tool? Because they're visual, all right? And even though that has changed a little bit, the vast majority of traders are still males. Males tend to be visual creatures, rightly or wrongly, okay? That's what we see. However, really, a moving average, all it does really is it allows traders to view smooth data. It just smooths the data, smooths the price action that we see. Many people will use moving averages to gauge the direction of the current trend and also its momentum. Like any trading indicator, they have plenty of pros and cons, which I will talk and share with you, okay? I don't, you've heard me say very oftentimes, there is no perfection in trading, okay? There is no perfection. It's very much about understanding the pros and cons of a concept, okay, of an asset class, of an indicator, and then being able to make a good, solid, decision about how you could utilize that in your own trading, if at all. But as you can see here, for those of you completely new to trading, here on a moving average, this you can see the blue line that's going through the price action chart there. Okay, and in that particular case, that is a 10-period moving average. And all that is doing is effectively whenever a candlestick close, okay, what we'll take is basically it'll take the last, for a 10 period, it'll take the last 10 closes, add them together, take an average and plot that. And as I said, that's what it's there. It allows traders to view smooth data, okay? It smooths out the data. And that can be very helpful for many traders, okay? That can be very helpful, all right? But as I said, there's pros and cons, okay? Nothing is perfect. And it's about understanding what are the pros and cons so you can make an informed choice. So what you'll find here is, you'll talk about, well, which moving averages should I use? Which kind of period moving average should I use? For those of you who followed me for a while here on the Admirals Trading Spotlight webinars, you'll know that I use very simple, kind of standard moving averages. You'll find I have a blue 20 simple period moving average, a red simple 50 period moving average, and a green simple 200 period moving average, which hopefully you can see there on those charts. If you want, you can actually go into much detail, okay, about all sorts of different types of moving averages, whether it be simple, whether it be exponential, whether it be weighted, okay, whether it be ton de mark, etc. There's all sorts of different variations. I like to keep things very simple. If you'd like to know more, then if you go into the Admirals YouTube channel, what you'll find is that there are actually specific sessions that have been done either by myself or my colleagues, Jens and Marcus, that actually enable specific focus on moving averages themselves. But for today, I just want to give you an introduction there, okay, that just for those who are completely new trading about what they are and how we utilize them. And today, we're going to focus a great deal on the 20-period moving average. So pros and cons, okay, of moving average, all right? So, in terms of, what people get sold in terms of, how moving averages can be absolutely stunning and absolutely fantastic and an easy way to trade is that, you'll be sold in the idea that, when a faster moving average crosses a slow one here, you just basically buy the market and then it always runs up. And then actually when the faster crosses back beneath it, that is when you actually leave. And that invariably sort of is, that's your entry there, that's your exit there, and the difference between would be your profit in your trading. Everybody looks at that and everybody thinks that's fantastic. So easy. Sign me up. I'll have some of that. It's a very simple visual representation of how you could operate within markets. Everybody loves that and everybody fancies that, and everybody thinks that that is a very simple, fantastic way to trade, which is great, which is excellent. The challenge you have, okay, because there's always a flip side, the challenge you have is that markets don't trend as often as we would like. Generally, I would say markets tend to trend between 20 to 30% of the time. So the other 60 to 70 to 80% of the time, the market is like this. The market is kind of range bound. And if effectively you buy and sell every time the moving averages cross, well, then what you'll find is that all that profit that you made in a lovely trend, you actually give back to the market, trying to trade through the whipsaws of a range-bound market. So as I said, every indicator has its pros and cons, all right? There is no perfection. It's about understanding what are the pros of one particular example, what are the cons, what are the downsides, and then you can actually either have tactics in place to mitigate, okay, the weaknesses, or effectively, you just have particular simple rules, okay, that allow you just to effectively, let's say, operate, using certain moving averages in certain trading environments. So, as I said, there's never any perfection. If anybody tells you there is, they're probably talking nonsense, okay? Some things in a trending environment, like what we just saw in the last slide, pretty much everything works really, really well. Everything works really well, okay, because it's a beautiful long trend. And here we talk about, as a new trader, ideally, that's what you want to be doing. You want to focus to try and capture parts of trends. The challenge, as I said, I have is that markets tend not to trend as often as we would like. And you heard me talk about it all the time, namely, a good trend will leap off the chart at you, all right? When you're doing your analysis, don't try and force it. Don't try and push it. A good trend will leap off the chart. If you find yourself having to force it or push it, the likelihood is it's not there, okay? And like anything in life, if you try and force it, it generally tends to sort of fight its way back, okay? So Anyway, moving averages, that's how they can basically, be utilized very often. Okay, as I said, they're a very simple visual tool. Work very, very well in trends. Okay, not so well in range bounds, but they can also be very, very helpful, some of them as we're about to go on, in understanding when a trend is likely to have come to an end and when actually the market is perhaps ready to roll over, or perhaps the market's ready to turn up. And that can be very useful and helpful for us. So with a couple of sort of, just final points on a simple introduction to moving averages, pre-COVID, I would talk to lots of trading conferences. I run trading network groups, okay, across Europe. And what would happen is people would come together, and invariably what you'd find is that people would get into heated debates about which is the best moving average. And some people will be saying it's the 50 period, others will be saying it's the 65 weighted, other people will be saying it is the 55 exponential offset 3 periods, etc. You could get into a very, very long heated debate, okay, about which moving average is the best. You could spend your whole life trying to curve fit it, okay, to basically find that. My general advice to traders is don't bother. All right, don't bother. As you see on my charts, I have a 20 simple, a 50 simple, and a green 200 period. Just keep it simple, okay? All right, I'm not using them to trade, moving average crossovers, okay? What I'm using them is to moving average to help define trends and also dynamic support and resistance, which is a topic in itself, ladies and gentlemen, and maybe that's what we'll look at in a future session. And as a general rule, I say avoid very simple moving average crossover strategies. You can actually sort of build a couple of elements come together where you have a confluence of events to basically, and the moving average crossover could be part of it. But as a general rule, okay, I suggest don't just try and trade simple moving average crossovers, because what will happen is you'll get chopped about in the whipsaw of range bound markets, okay? You're going to try and trade moving average crossovers. They tend to only work in really good, strong trends. And as I've said a few times, good, strong trends, they don't appear as often as we would like. We'd all love them to have nice long trends running, constantly, but that's just not the way markets work, ladies and gentlemen, all right? So just as I said, always know what the pros and cons are. So that was just a little bit of a quick introduction for moving averages, because as I appreciate there are people who are completely new to trading. But let's in particular talk about the power of the 20 period moving average, right? How do we use it to basically, understand a reversal? Well, what we can often see is that, we've got a couple of examples here. Very often, once a price has been in a trend and that trend is coming to an end, very often the market will print a reversal pattern. Once that reversal pattern is printed, well, then we can utilize the 20 period moving average as confirmation of that reversal having taken place. We watch to see how does price react to the 20 period moving average after the reversal pattern. Does the 20 period moving average provide dynamic support in a bullish reversal, or does the 20 period moving average provide dynamic resistance in a bearish reversal? So, I have a little chart here, okay? As you can see, you probably don't know what instrument that is, and you don't know what time frame that is. And that's the idea, because this idea, this tactic, like pretty much all the other ones I've shared, I always try to share something that is time frame and instrument agnostic. Okay, doesn't really matter what you trade, doesn't really matter what time frame you trade. You will see, okay, this phenomenon occurring again and again and again, up and down the time frames, all the way across the instrument. So maybe people here, joining us today, maybe some of them are, like to trade 5-minute euro dollar. Maybe some people like to trade, monthly charts on gold. Maybe some people like to trade hourly charts on the Dow. Maybe you want to trade, daily charts on Bitcoin, etc. Whatever it is you trade, once you start to recognize and see this phenomenon, see this setup, you'll realize it happens a good deal more than we can expect. So in this particular example here, hopefully you can see from the left, price has been in a nice downtrend. It's been moving away, just trending its way down nicely. Makes a low here, doesn't it? Rallies its way up. But just look, I've got a blue 20 period moving average here. And what happens is the first time it touches it, okay, price drops. The next session, okay, price tries to push above it, but it just can't. And then basically price drops down. Now, suddenly what we've formed here, as you can probably see, is a double bottom. Price once again comes back up to that 20 period moving average, but it can't close. The next session, it actually can't close above it, and it drops away. So in this particular case here, what we've had is actually the 20 period moving average has been acting as resistance. Every time prices come up, it's bounced. But suddenly, okay, we start to have this double bottom pattern, and then look what happens. Let's just start to see what happens. We see that actually the price starts to get above the 20 period moving average. And in fact, it comes back down here. In the next session or two, price comes back down, but it can't really close. And actually we see this huge, big bullish candle, right? Big bullish candle that closes a good way away from the 20 period moving average. Price rallies up to the 50, okay, and where this sort of resistance level is, and then price comes down again. But look what happens on this particular session. Price effectively, opens and falls all the way down here, okay? But actually, the bulls step in and push price up, and price closes above the 20 period moving average, okay? It can't close beneath the 20 period moving average. Whereas here, the 20 period moving average was sloping down and acting as resistance. Now look at it. The 20 period moving average is starting to flatten out, and now it's flipped. It's flipped, okay, from acting as resistance to now acting as support. A couple of sessions later, we see that the 20 period moving average is now pointing up, and when price comes down to it, the price bounces off it, okay? Whereas it was resistance here, now it's starting to turn in support. Then we get sort of, rejection candles, pin bars, and what do? The price pushes down, but it can't close beneath the 20 period moving average. Now the 20 period moving average, as I said, it's sloping up, and it's closing back above that 20 period moving average before price starts to rally up there. So hopefully what you can see is that, a very clear downtrend, which then prints a reversal signal. And of course, some people would be very happy just to trade off that double bottom reversal signal. Once you start to get that 20 period moving average involved, we're using it as a confirmation that a reversal has happened. And A, it gives us confirmation the reversal has happened, but B, it also starts to give us an idea of actually, hang on a minute, the market's turning. I could utilize this as an opportunity to trade in the direction of what may well be the new trend. Remember, as I said, no perfection, but this is just a very visual, simple way to start to A, confirm that a reversal has occurred, and B, start to give you a couple of ideas and examples of how you could actually start to trade in line with the new trend. So, as I was saying before, you're looking to see, does the 20 period moving average act as either a new roof for shorts or as a new floor for long for buys? Okay, when the 20 period moving average acts as a significant dynamic area of interest, then we can have confidence to trade in the direction of the reversal. Okay, that's what we're saying. Remember, it has provided a double bottom there, but then as soon as we see the moving average, as soon as we see those moving averages flip, all right, from being resistance, from being the roof to being the support, all of that starts to sort of give us an indication that the market is turning. We get confidence that the reversal has actually occurred. It's not a fake out. It's not a false reversal. Okay, it's not just a little retracing along trend. The actual reversal has occurred, and that provides us with an opportunity to get on board and to sort of to take a trade in the new in line with the new direction. So once we can see the power of the 20 period moving average to confirm a reversal, then we can utilize any of the price action setups that we have previously discussed in Trading Spotlight webinars of the past as a trade setup. So things like pin bars, rejection candles, engulfing candles, key reversal candles, domino candles. In this particular example here, what immediately leaps off the chart to me here is these two candles here. You can see that, which are both great pin bars, okay? Both great pin bars, rejection candles. Let's just draw in here, okay? And invariably, that was a fantastic opportunity to get on board those trades, because what we look at is effectively, we know as let's say a standard order, is that basically we know where we can get in our trades, okay? Just above the highs. We know where our stop loss, okay, can be, which is just beneath the low, because we know if price actually just takes another dump, well, then actually we don't want to be part of it anyway. So we know where our stop losses are. We know where we can be wrong. And then what we can see is that invariably, we can look and we can work out there, we understand what our trade risk is. So then we can look to identify an asymmetric reward to risk ratio for our trade, maybe 2-to-1, 3-to-1, 4-to-1, depending upon the market conditions, depending upon our own particular risk sentiment as well. So we're looking for ideally a reversal pattern followed by that 20-period moving average flipping, okay, in this case flipping from resistance to support, and then providing us with simple price action triggers. You've got a confluence of events, and you've heard me talk about that many times, a confluence of events about what is going on, okay? When these things come together, that's where our trade is. So I actually got a few examples here just across of different instruments, different time frames, different setups, okay? So you can start to sort of get an idea and understanding of how you can actually look and what we're particularly looking for. So this is like euro yen on the hourly chart, and actually, maybe you can see that actually in the uptrend, the 20-period moving average has acted as support. Okay, whenever prices come back to it, it's bounced off it. But we make a high here. Okay, we make a high, we break out. Okay, make a kind of a bit of a false breakout. Price reverses, and what do we start to see? We start to see price closing beneath the 20-period moving average. Furthermore, we can see, whereas the 20 has been slanting up, now it's reversing over, and we see price drops down to the 50, bounces up. But what do we see here? Okay, what do we see here? Price pushes up to the 20, but it can't close beneath it, can it? Next day, can't get above it. Now, the day after, bang, it pushes up again, and actually it can't. And what does it do? Well, it prints us a nice pin bar, a nice rejection candle. Also, the 20 is effectively reversed and rolled over. And that's the way it is. Domino candles they're just a particular form of rejection candle, and what we'll do is I'll cover them specifically in a proper session. Okay, but it's just another type of rejection candle, not massively dissimilar to a pin bar really, but I'll take that as a reminder, and I'll do a specific session on that for you all. But in this particular case, what you can see here is price can't basically close above the 20, can it? Every time it pushes up, it gets knocked down. The 20 has flipped, all right? The 20 has flipped from being support, now it's resistance, and the 20-period moving average is now moving downwards as well. And Fred says it's a beautiful head and shoulders as well. You're absolutely right. And there's nothing wrong in that. There's absolutely nothing wrong in that actually there can be, you can actually have 2 or 3 patterns coming together to show you that, there is a reversal occurring, and, it's that confluence of events. That's what actually works. That's what works best for us. But you can see that, once that flips, and then you can see for yourself that actually what happens is price just collapses very, very strongly. And there was an opportunity, really, here to trade. Okay, you might even say also, here and also here. Okay, there are opportunities to trade those rejection candles off the 20-period moving average to give you an opportunity to get a nice healthy reward to risk on your trade to the short side. Next one, this is crude oil on the weekly chart. I'm just putting all sorts of different examples to give you an idea. Price was in a fabulous downtrend there, okay, and we can see here that the 20-period moving average is sloping down, and it's acting as resistance, isn't it? Price bounces off it, and that in itself is a nice trade. But then we put in what we call a 1, 2, 3 reversal there, okay, which has given us the first idea. And then price kind of rallies up above the 20, and then it falls back down to the 20-period moving average. And what this candle is, that candle is pretty much like a domino candle. It's a rejection candle. The 20 has gone from being, resistance and sloping down. You can see it's starting to turn, okay, and now price has flipped. Price has flipped from using the 20 as resistance. Now it's a support, and actually, just that run there is just, it's a handsome reward to risk on itself there, okay. So that's, we're looking for, just as I said, across all time frames, instruments, we will see this kind of setup show up, quite a few times. This is the Nikkei on the 4-hour chart. Hopefully you can see that, once again, price has been in a nice downtrend like that. Then what happens is we get a big rejection candle here, which then actually becomes part of a bigger double bottom, doesn't it, there? And what we can see is, we can see that, here price is using the 20 as resistance, here and here price is using the 20 as resistance. But then what happens is, we get a close the other side of the 20-period moving average. And then watch what happens. Price flips, doesn't it? From being resistance, the 20-period moving average now becomes support, okay? Now it becomes support. And some people will be very, that they might say they'd like to trade something like a doji like that, or a strong rejection candle, or a pin bar, or even, as price moves up a little bit and comes back again, what we can see is, from sloping down, 20-period moving average is now sloping up. Once again, price comes down to the 20 and it can't close beneath it, can it? It can't close beneath it, okay? And it's showing us that the price action has flipped, right? It's flipped from a downtrend to an uptrend, and this is confirming it. It gives us confirmation the reversal is occurring, and also opportunities to get on board what is this kind of new particular trend. DAX 30, okay, which is one we've seen before, okay, we've used this kind of example earlier, but you can see for yourself, okay, it's a case of 4-hour chart, price is, in a trend down, you can see that for yourself, you can see that price, is bouncing off the 20-period moving average there, it's acting as resistance there, then suddenly price flips after the double bottom, okay, after the double bottom, price flips, it bounces up, comes back down, and then, as we said earlier, the 20 is now turned flat, starting to move up, and we can see prices flipped in the sense that it now effectively is just looking to use as support. It's turned up, and you can see for yourself that actually price rises very, very nicely from that. So, as I said, there's always pros and cons. One of the cons for this is that you have to be patient. You have to be patient and wait, okay, for it to sign up, to settle up for you. Okay, now I appreciate if you're trading like 5-minute charts, you might not necessarily be patient for that long at around a reversal. But if you're trading this on 4-hourly charts, daily, weekly, maybe even monthly, well then it might take a little bit of time to basically show up. But that's that's one of the arts of trading, is being able to be patient. What I've learned in my own trading career is it's easier to be patient when you know exactly what you're looking for, okay? If you know exactly what your setup is, it becomes easier to be patient. It becomes easier to do nothing because you don't get drawn into chasing impulsive trades because you know exactly what you're going for. Here's a sort of a different example. This was this is a Dow on the 15-minute intraday. And what you can see for yourself here, can't you, that a price was in a nice uptrend. The 20 was acting as support. Price pulls away, okay, and then it comes to make what they call a 1, 2, 3 top, right, and then price rolls over. It hits the 50, bounces off the 50, but what we can see is, hopefully you can see by now, is the 20 is turned, okay, and it's from being support. It's now flipped to being resistance. And what do we get? Well, we get a rejection candle there, okay? Real rejection candle. There's an opportunity to get our entry in, okay? We know our stops above there, the highs of that, okay? The low is the break of it. And you can see, there's easily 2 to 1 there. And in fact, actually, you can see, you're really close to sort of probably 5 to 1 is actually where it closely ended up. So, this is this is a Dow 15-minute. You will see this happen across all sorts of time frames, all sorts of instruments. It's just about being a little bit just to be a little bit patient, okay, in waiting for your setup. And this, this is just another example here. And this is actually Nasdaq, okay, on the, here we go. Let's get it all drawn to. This will be the Nasdaq on the 4-hour, and we can see that actually, as it's in an uptrend, we can see the 50, okay, and the 20 act as nice support, okay. Puts in a double top there. All right, sorry, excuse my drawing. Let's just draw that again, shall we? Okay, I'm a better trader than I am an artist. Okay, price drops beneath the 50 and it tries to rally back up. But what happens here? We can see the 20 is turned, right? And now we've gone from, look at that. Okay, price tries to rally up to the 20. It can't, and what it does is it prints a rejection candle. Okay, it's a pin bar bouncing off that 20, which is turned. Okay, it's from being heading upwards at support. It's reversed and turned, and then you can see for yourself that's what happens, the price there, okay. It's given us that confirmation that the reversal has occurred and that we're actually just about ready to roll over. And an example here, okay, a pound against Swiss franc, because actually this one takes a little bit of time to play out, but that's okay, because actually You can see the price is in a really quite strong downtrend, and then what happens is it prints a reversal pattern here, okay, in terms of, it's a bullish engulfing candle, and price actually rallies up, okay, it rallies up, and then it comes back, and what does it do? Right, what happens is we see that it prints a rejection candle because the 20 which has been sloping down, as you can see for yourself, is turning its flat, starting to nudge its way up. Price comes down and retests it one final time, prints in a pin bar, which is also our price action entry before it launches itself up there, okay. Once again, 2, 3, 4 to 1, okay, trades are very, very plausible. And a different example on the Kiwi dollar, okay, on the Kiwi dollar, on the daily chart, okay. Let's get the old drawing tool up here. Is that price has moved up, price rallies up, puts in a shooting star there, okay, to signify a possible top, and then we see price actually sort of just fall away, don't we? Price falls away, and then it gets beneath the 20, and look at it. Once that happens on that day, the price closes beneath the 20. Look at it, even though it touches it, it can't close above the 20, can it? It can't close. And actually it comes back a couple of times, puts in pin bars there, okay, as the 20 is starting to sort of slope over and slope away. And we see the price comes down again, hits the 50, bounces up, puts in a small little rejection candle as the 20 is turned down, and you can see for yourself the price falls, price absolutely collapses there, okay, and that's on the daily chart of the Kiwi dollar. Here we go, Kiwi dollar against Canadian dollar. And as I said, I tried to show lots of different examples and different time frames of different asset classes, just to give you a little bit of an idea and understanding that these occur across the way. And what we have is, here we go, is the price was basically dropping down, a reverse there. It's looking like it's starting to put maybe a head and shoulders is building. What we see is basically price gets above the 20. Price gets above the 20, that basically is basically we're just drifting our way up. Price comes back down here, and look at now what's happening. The 20 period moving average is starting to turn up, and what we're getting is it can't close beneath it, can it? And here we have what do we have there? A nice little rejection candle. It's getting squeezed between the 50 and the 20, and that's that's the confirmation that the price, this 20 is supporting, okay. It is reversed, and actually you can see for yourself, bosh, off it goes, off it flies that way. So, before we switch across the live markets for we've got the last 5 minutes or so, many traders like to try and trade a reversal, with many traders overcomplicating their reversal setups. Whereas I believe we should keep things quite simple. Moving averages can be useful for helping identify trends, but they can also be useful for confirming our reversal. Trading bounces off the 20 period moving averages using price action is a simple way to have a confirmation that reversal is occurring, and a simple way for you to actually get on board and trade the reversal in what is looking like will be the new direction. So with that in mind, why don't we have a little look at the live markets? We've got about 5 minutes or so. We can go and have a little look at what's been going on there and stuff, because I appreciate that, it is always the way that you can look at something on slides and stuff, which is all well and good, but it's not really until you actually get to see see live markets that you might be able to sort of put it into some sort of a context. So as always, before we switch across to the live markets, if you've got questions or thoughts or comments, you can get in touch with us, at admiralmarkets.com website, or global at Admiral Markets will basically take you there to effectively, you can get in touch with us that way. And as I said, this video and many others, okay, will be on, both the YouTube channel and the Facebook channel. So hope you found that a bit useful. Let's just switch across to the live chart, shall we? So just bear with me a minute, and we'll just do that, and we'll switch across to the Admirals channel, or the Admirals platform. Bear with me one moment. Okay. Well, I'm hoping that you can still hear me, hoping you can see me, and I'm hoping you can see the Admirals MetaTrader 4 platform. Hopefully that'll all work. And one of the, it's nice when things like this actually works in terms of, you can see that, just going on in live markets is actually, the sort of the setup that we're actually been talking about. So I'll show you sort of a few examples of that here. So this is a profile I have just set up for indices here, okay, just simply for indices. And you can probably see the major ones there. I've got them all on the weekly charts there. So, we have I've got here the Dow, okay, here I've got the S&P 500, here the NASDAQ, here the DAX, the Nikkei, the Australian ASX 200, and then here the UK FTSE, okay, and that's US Treasuries. But these indices there, that gives me a quick example of what's going on, and I can very quickly take a snapshot of what's going on in those kind of equity indices and understand that. But if we have a little look at here's the Dow Jones on the 30, okay, the Dow 30 on the weekly chart. And what do we actually see here? Okay, as well, as I said, this is the weekly chart. Get the old drawing tool. Remember what I said earlier for new traders. Good trends leap off the chart. That was a very simple trend. Okay, that was using the 20-period moving average. Okay, for a lot of support. But then we get a bit of a false breakout here at the start of the year. That's with a shooting star, and what we see is price collapses and drops. Okay, drops away from the highs. And then what happens is it tries to have another final rally. And here it rallies up. But hey, presto, what happens on those two candles there is that we can see the 20-period moving average, which is acted as support, has now started to flatten out, starting to turn over, starting to roll over. And here we have nice rejection candles here, okay, that basically give us opportunity to get on board, to get a little bit of a run down there. But then actually what happens again is price rallies up there. And what do we see here on the weekly chart? Price rallies up to the 20, which has now gone from being, okay, dynamic support in an uptrend to rolling over and pointing down, okay, and then we get we get a nice rejection candle there, okay. Then invariably it happens because off the 20-period moving average, off the big round number, and we see for the next couple of weeks that price is actually rolled and price has actually just moved down quite nicely there, okay. And we'll wait to see how that plays out in the next couple of weeks. But the setup is is absolutely good and proper for what we actually sort of want to see. So what we'll see is that there's quite a few of that occurring across the American indices at the moment on the weekly charts. There's the S&P 500. You can see for yourself, great trend there, wasn't it? And great trend with the 20 acting as super support. Then we get a top here with a key reversal, price falls and then tries to push up. And what happens here is we get two, okay? We get two pin bars, two rejection candles. That in itself is a trade there before price drops. Then price actually tries to rally again, but what stops it is we see the 20-period moving average has gone from an uptrend, rolling over to a downtrend. And what is it printed there? Well, it's printed itself. I'll just move this out of the way. It's printed, it's pin bar rejection candle. You can see for the last 2 weeks, price has actually dropped quite nicely there. So, as I said, you need to have a little bit of patience to wait for the trend, to turn, especially if you're trading something like a weekly chart. But it is a case of it's easy, as I said, it's easier to be patient when you know exactly what you're particularly looking for. And actually, there's quite a lot of examples of this. So this is the Nasdaq. Okay, once again, it's the weekly chart. Okay, you can see great trend where the blue 20-period moving average acted as great support. Then we hit basically here, which was a bearish engulfing candle, which then became a sort of double top. Price gets beneath, okay, the 20-period moving average. It does actually drop a bit, but then it comes back and look what happens. The blue 20, which has been acting as support, it flips, price pushes down, and what happens here? Let's see if I can zoom in a little bit more for us. Okay. Hopefully you can see there where the arrow is pointing. Price rallies up, but now the 20, look how the 20 is acting, okay, as now resistance, and actually price rejects that, doesn't it? Rejects the 20, can't get above and close. Pin bars, and then what's happened for the last 2 weeks? Price has just dropped. Price has just dropped nicely, okay? And so just kind of nice, simple, relatively easy trades in that sense. And that's the sort of thing that we've been looking for. If we look at basically, I think even on the DAX and stuff, even on the DAX, here we go, is a weekly chart. Price has been moving up. Price used the 20 as support, started to get behind. Okay, makes one, PO20 there, okay, with a kind of rejection of it, and price drops a bit. Price goes up, makes a new kind of false breakout before it rolls over. And then what we see is price, pulls up a bit into what becomes effectively a double top before it rolls, okay. And then what we see is the price action. Then it tries to push up and it can't get above the 20 now. And then it collapses and closes right beneath the low. That in itself is a trade. The next candle, okay, is a trade, okay. It's an inside bar pin bar that can't get above the 15 and the 20. And even you might even say the next candle is as well, but definitely the first two before price actually made that kind of really big drop there. So hopefully you can have seen that, okay. Hopefully you can sort of see how, just in live markets, that's how we're actually that's how it actually plays out there. So there you go, ladies and gentlemen. Unfortunately, we've run out of time as always. And, I appreciate we could talk all afternoon about trading, but we're unable to, we're run out of time. But I'm hoping that has given you some great insight into the power of the 20-period moving average and how something very, very simple can be used to confirm a reversal and then also give you a possible entry into the new trend. As always, I wish you the very best of success with your own trading. Please remember that, you'll be sent a little feedback form straight after this. Great if you just take a couple of moments just to fill that in, just to let us know what you actually thought, if you found this useful. As I said, if you're watching this later on YouTube and you found it helpful, give ourselves a thumbs up. We'd appreciate it. And as always, I wish you the very best of success in your own trading, ladies and gentlemen, and I look forward to speaking to you soon. Trade well, everybody. Cheers.